2023 is the year to put your money to work, but a real tangible asset's the better bet. Let's take a closer look at the infrastructure behind energy, agribusiness, and the bearish sentiment holding back investments in Europe. Joining us now is Greg Swenson, Brigg Macadam founding partner. Good to have you on the show, Greg. So I know that we're mentioning Europe there. You're saying it's not the time to buy, at least not yet. What are some of the factors that are driving that outlook?
Yeah, I think there's maybe too much optimism right now because the winter wasn't as bad as people expected. It was so far, a relatively warm winter, and the Europeans, led by the Germans, were able to cobble together enough energy supply. So the energy crisis is not quite as bad as a lot of the market expected. But I think that doesn't really help us next year in terms of energy supplies. So I think that's the real concern. Next year, you still have some inflation. In spite of the fact that the Germans and other countries were able to get some supplies in, and the winter's been kind to the market, you still have much higher energy inflation in Europe, and that's a headwind to the market. So look, I don't think long term it's such a bad move. In fact, if you look at the worst performers of last year, small cap Europe and as well as small cap US for that matter, were some of the real laggards. So I think there will be a time once we get through some of the headwinds, see how earnings are in Europe, relatively or historically, it's relatively cheap to the US markets. So I think there is going to be some opportunity, and because small cap Europe really lagged last year, I think when the Fed is done, when the ECB is close to done with tightening, and you start to see a potential move back to easing toward the end of this year and early 24, it'll be time to dip your toes into the European markets.
So, Greg, we know what you're not keen on, but what about what you are keen on? You're talking about some of these more tangible investments. Break down some of that, because you talk about alternatives and real assets here.
And part of it is the timing. The last year, since the Russia invasion of Ukraine, you saw an elevated interest in critical infrastructure, notably in food security and energy security. That's not something that's changed for us. It just, as I said, elevated it to front page news. But energy infrastructure, food security, and energy security have been exceptional, non-correlated, and inflation-protected investments. So in whatever your view is on inflation, whether it's coming down or whether this is a bit of a head fake, you can invest in real assets that are critical infrastructure and really address the basic needs. So there's a lot of opportunity in those sectors, and we would advise looking for opportunities, especially in emerging markets. You saw, Latin America performed really well last year in terms of fixed income because it's correlated to commodities. You'll see that opportunity in Africa and other emerging markets and frontier markets that are correlated to commodities. So long-term view on critical infrastructure is still very positive.
And what about in the shorter term and the midterm? I know that you're also keeping an eye on the real estate investment as well. What sort of trends are you looking at? And what are the factors that really make for a good investment in real estate right now?
Yeah. I think, look, there's still some headwinds. I think you've got obviously high vacancy rates in the office sector, especially in cities like Chicago, which you should probably avoid. But I think, that it was, speaking of sectors that did really poorly last year, real estate was one of them. So I think as the mood shifts later this year from, getting through the recession, regardless of your view on whether it's going to be severe or not, or even a soft landing, as the sentiment changes toward the end of the year, I think a move into the real estate sector in general. And then also, we look at opportunities in emerging markets. I mentioned Africa, but also in Latin America and Asia. If you have markets that have underperformed, the most important thing in those markets is if it's dollar correlated and you have off takes in dollars and especially with good credit, leases, I think that's a real opportunity, and we see a lot of interest in those sectors.
So for perhaps newer investors who are wondering, should I hold on to my cash? Should I try and enter the market through an ETF? How would you advise them in terms of making the decision as to the way they should be heading right now, since there is so much uncertainty in the economic backdrop?
Right now, to me, it seems really obvious. If you can buy T-bills at in the fours, 4.5% for 6-month bills, roughly. That I think is a great way to get through this uncertainty, get through some near-term volatility with this inverted yield curve. Hold off on long-duration assets, both long-duration equities like tech. I think the tech rally was premature. The valuations aren't that cheap, and same with long-duration fixed income. You have an inverted yield curve, so put your money to work for 6 months in T-bills or high quality money markets that are, in 4.5% to 5.5%. Why wouldn't you do that for the near term and then start to make some long-term rotation decisions toward mid-year or toward the end of the year? And in the meantime, stay defensive.
All right, there you go. Stay defensive. Greg Swenson there. Brigg Macadam, founding partner. Thank you for joining me. Thank you for your time.